Last week, there was a strong short squeeze in the American stock markets. This means that when those who were trading downward positions were squeezed to close their positions, there was a sharp upward movement. Was this the beginning of a Christmas and year-end rally that will continue until the end of the year, or was it just a short squeeze? In the upcoming week, the macro picture will once again take center stage. Markets will regain their composure, and we will see if the trend turns downward again. In this video, we will evaluate these factors. Let's get started. Agenda and market analysis. Yes, the American stock markets had one of their best weeks almost all year last week. They closed the week with gains on all 5 days, especially the Nasdaq, but even the S&P and the Russell 2000 joined the rally. We've been analyzing market fluctuations for months now, but what's interesting is that, besides the Magnificent Seven, meaning the 7 largest companies, there were generally not many major disruptions. In fact, last week, we saw some short squeezes, some rallies, and some healthy movements in other stocks as well. From that perspective, the analysis gains importance this week as we also witnessed some healthy rebounds when looking at stocks moving to the downside. However, these rebounds were mostly limited to the large cap stocks, and we can say that real money is flowing into the system, resulting in a significant shift. For instance, Nvidia dropped below $400 and then climbed back up to $450 within the week. Tesla, despite disappointing earnings, managed to consolidate, and Apple, despite a very negative and unsatisfactory earnings report, even attempted to recover. Similar scenarios can be observed as well. Therefore, when we look at the bigger picture, the macroeconomic landscape still contains challenges. For example, the Fed's stance on the market, which has not been priced in yet, particularly when it comes to rates. Powell delivered a speech just as expected, without changing any sentences, but the market responded with, "Okay, so we're starting to ease here." As I mentioned in previous weeks, I'll address the divergence in the 10-year Treasury yields in the upcoming Week 3 video. I'm expecting a reversal there, but we need macroeconomic improvement for the sustainability of the move. Now, let's take a look at historical patterns. For example, let's see what happens after the Fed stops. There are instances where the Fed paused after raising rates, and then, there's a period where they start lowering rates. When we look at historical examples, we can see that markets, especially in 2000 and 2008, didn't turn very negative right after the Fed paused. They usually tried to go up for a while, and then eventually turned down. In fact, in the big picture, after the Fed paused, a general trend is that it often leads to a recession in the economy, and as a result, they have to lower rates. So, if the Fed pauses and starts lowering rates again, this would likely be a sign that the economy is deteriorating further, and it could signal that things are getting much worse. As for the real economy, one of the most crucial indicators is related to shipments and product traffic. The CEO of Uber's freight division has stated that there's a significant freight recession happening. He mentioned that international trade is abnormally slowing down, with a 10% decrease compared to a year ago. This signifies a significant issue in the international traffic and suggests a decline in goods traffic. Similarly, one of the world's container giants, Maersk, is reportedly laying off 10,000 workers. This shows that international trade is facing severe challenges. Slowdowns in transportation, just like the decline in international trade, are expected. So, the impact of war, recession, high interest rates, the global economy, all factors to consider, and it seems that things are truly getting challenging. Meanwhile, while things are getting difficult, how is America's debt situation? In this graph, you can see the ratio of the potential GDP of the United States to its national debt from 1900 to 2053. There has always been a certain level of debt relative to GDP, but in recent times, there's been a rapid acceleration. The debt-to-GDP ratio for America has been on an abnormal and negative trajectory. If this pace continues, it's inevitable that things will go out of control, and it will lead to a major crisis. Now, let's quickly take a look at our charts. Nasdaq closed at 14,610, and our trend-following level is there. Of course, last week, we had started with a headline stating that we saw sharp declines. However, from the beginning of the week and especially after the Fed meeting, and following the non-farm payroll report on Friday, there was an extreme optimism that pushed the market higher. In essence, this is the result of the robot's perception and algorithm, which interprets good news as the Fed not raising rates. This way of thinking might not be in your best interest because investing in risky assets like stocks when you believe that things are going well doesn't always make sense. So, it's worth reconsidering that logic. However, the robot doesn't see it that way, and the algorithm is designed to keep the system functioning this way. Now, how far can it go? There's a descending channel right at 15,175, where it closed on Friday. There's a high probability of a sell-off from slightly above these levels because we've had a relentless upward move. Last week, I mentioned this: if you're trading in the short term, pay close attention to the trend following levels I provide. If you have a low leverage or leverage-free position, it can guide your trading according to the macro picture. However, if you're trading with high leverage in the short term, please pay attention to the trend following levels, and try not to stay in a position against them. These levels will help protect you. This is why I create these broadcasts every week. As long as Nasdaq remains above 14,610 in the short term, there is a possibility it could go a bit higher, but it cannot cross 15,175. It will be necessary to closely monitor any reversals from this point. The formation here might break through to 15,175, perhaps making a move of 400 to 500 points, and then potentially experiencing a sharp decline. In that sense, the formation is somewhat unusual. Originally, there was a triple top pattern that should have broken down immediately. However, the buying last week changed the picture. Now, they are trying to create an optimistic perception, but the macro picture is still quite negative. So, when the technicals align with this, short-term traders will determine it. We also had a nice rise in the S&P 500. At 4,404, there's a very strong resistance area. If the rally continues up to that point, and even a bit beyond, we may have reached 3,588. There is a strong resistance and a possible reversal point there in this formation. However, if you're monitoring your positions or are long, those are areas where you can consider selling. At 4,224, just a bit below, lies the trend following level. Daily closings below this level could break it, but if a formation is established here, remember that fast moves can bring about quick reversals. We've walked along the path of gaps in the spot market, so pay attention to this as well. If there's a reversal, investors may be forced to reopen short positions, or at the very least, they could see it as a selling opportunity. However, you know that those in control of the system always want to push the market upwards. But whether they can do it depends on macro reasons. The troubles in world trade, as I mentioned earlier, along with the economic slowdown in America, will eventually impact prices. So, we will be monitoring how well the technical picture aligns with the macro picture. We have a similar situation in Dow Jones. 34,180 is a key level that it closed on Friday. If it can't break above this level, it will likely act as a strong resistance, and we'll be monitoring this area closely. My trend following level for Dow Jones this week is 34,180. My trend following level for Apple is at $178. If it can break through the channel coming from above, we might be convinced that a new wave has started. However, for now, we'll closely monitor where these movements will lead. There's a possibility that if there are closures above $178, a new scenario might come into play, so we'll approach this cautiously. Sometimes, as I've mentioned throughout the broadcast, the technical picture may not align with the macro picture, just like it is currently. In other words, the market can price in overly optimistic scenarios for a while. But later, reality can set in again with a news event or data release, sometimes causing a sudden downturn. We are currently in one of those critical moments. So, we will adopt a more cautious stance, keeping an eye on both sides. So the 200-day moving average for Tesla is at $230. My trend following level is below it, which means I am negative above it. This is because we had a well-established double top pattern that had been broken to the downside. We reacted with a rebound, but now, as long as we are still below the 200-day moving average, there is a possibility of more selling pressure coming in from that level. You may remember that Nvidia dropped below $400. However, it couldn't hold below that level and quickly rebounded. Despite the fact that its largest market is in China, there are issues on both sides, with the US not wanting Nvidia to sell its AI chips to China, and China not wanting to purchase them from the US. While Nvidia had lost its biggest customer there, it rebounded as if nothing had happened. This once again shows that real news doesn't necessarily impact the market, and there is an incredible level of manipulation occurring. The trend following level for Nvidia is at $430. Don't get crushed under this manipulation. I always recommend that if you're going to trade stocks, especially on the short side, consider using options. Naked short trades can be exhausting and damaging. Avoid naked shorts in stocks. However, for indexes, you can use stop orders or other tools since stocks can make sudden moves in both directions, with sudden 20% drops or surges, which can be detrimental to your portfolio. And let's quickly take a look at cryptocurrencies. Bitcoin has been doing some interesting things, suddenly spiking up and then retracing as if nothing happened. However, there has been a positive trend for a while in the main direction. The trend following level I'm watching is $34,300, but it was at $34,730 when I was recording this. If it breaks above the $36,000 level, it might be entering a significant move towards $45,000 to $50,000. However, if it doesn't, there's a peculiar W-shaped formation here, and it could suddenly turn negative below $34,300. So, in the big picture, I'm positive on Bitcoin because it's starting to behave like gold in this environment, which I like. But the fact that it's risen with ETF news makes me quite uneasy. That's why I'm more cautious. Below $34,300, I'm negative, and above it, I'm positive. Similarly, for Ethereum, it's at $1,795. I'm positive above my trend following level, but negative below it. We need to be cautious about whether the formation that has emerged is preparing for a drop or if it's the final rise within a band before a decline. There's a lot of volatility, but there doesn't seem to be an atmosphere of monetary expansion in the macro picture. Therefore, there are still concerns related to cryptocurrencies in the macro context. However, we can distinguish Bitcoin. I still have concerns regarding other coins because the macro picture remains unsettling. There is no monetary expansion environment in the long term. However, I have a considerable degree of optimism in the long term, especially for Bitcoin. I've tried to evaluate various products for you in these broadcasts. In the videos of the week, I will take a look at the precious metals market. I wish you all very cautious and profitable trading. Have a great day.